Hi guys, I hope you all are doing well. So welcome to the session. We are going to start off now. The agenda of the session of today is that I would try to go through the mock examination that has recently been uploaded by the ACCA. So what I would try to do is that I would try to go through the mock examination and we would try to actually cover up that mock examination. That's what I'm actually going to try and do. So let's just start off discussing basically, how to access the mock. You could just go on to this ACCA website, which is cbept.accaglobal.com. And so you could just go into that. And then what would happen is that you would be able to access the mock examinations from here, ACCA Advanced Financial Management. And we have got this mock examination. So this is the mock examination that we have assigned to ourselves. Now with respect to the mock examination, just wait a bit, let it appear here. I just need to check where is it appearing. Okay, here you go. Now this is APM. Why am I not getting to see the AFM one? Why is it not appearing? Okay, now I've actually assigned it. It should appear here. Just a second now, please. Okay, so I've just started off this AFM mock examination. Now what happens is that, see, the approach that I'm going to adopt here, probably I would adopt the same approach in the examination also. So I'm actually going to start off, this thing that you will get two sections, section A and the section B. The section A is going to be 50 marks. Section B is going to be 25 marks into 2. Now what next is there? The next situation is, as we move, we have got section A, we have got section B. Now let's just try to see what things are. So the first question is actually about the section A. And the section A, the following exhibits available on the left-hand side of the screen provide information relevant to the question. So what happens is that the following exhibits available on the left-hand side of the screen provide information which is relevant to the question. Now what next is there? The next situation is that there are these requirements. So I'm just going to look at the requirements and see that what requirements are. The requirements are, it says, discuss how the real options theory can be used alongside net present value to help companies with their investment appraisal, to help companies with their investment decisions. Then prepare a report for the board of directors of DERANC, which calculates suitable weighted average cost of capital, NPV, estimates the value of follow-on project in dollars, discusses assumptions made in the calculations. I'll just copy this. Okay, so we have got these requirements. Now what I've done is that I've actually copied all these requirements in here. And so I've just copied all these requirements in here. That's what I have done. Now what next is there? The next situation is, let's just talk about the Durand company. That what exactly is Durand company? Can you just read through this quickly in 1 minute? Okay, so it says Durand company is a listed refrigerator manufacturing company. Durand company is a listed refrigerator manufacturing company based in Medonk, a Central European country whose currency is the Medong dollar. Okay, so Medong dollar. Now, it is considering expanding by setting up a new factory in the neighboring country, Frontland, where the currency is Frontland florin. So that's what you have. Now, we talk about the cost of capital. So can you just read through it? Can you just read through it? Okay, let's just start discussing now. So basically it says Durand company's capital structure comprises of 200 million shares, because you see one of the requirement of the question is to calculate the weighted average cost of capital. So what am I actually gonna do? I'm actually gonna see this and I would say that, okay, let's just see. So basically you have got Durand company. The capital structure comprises of 200 million shares trading at $3 each. So number of shares, $200 million. Market value of each share, $3. And $100 nominal value bonds trading at 110 per 100. Bonds, $100 million. Market value of bond, 110. It has an A rating according to the biggest credit rating agency in Medonk, and this corresponds to credit spreads of 55 basis points. Credit spread is equivalent to 55 basis points, means 0.55%. This is expected to stay unchanged as the company expands into Frontline. Durham company has never operated in Frontline before. However, one of its competitors, Clunish, expanded into Frontland a few years ago and now operates successfully in both the countries. Directors consider the systematic risk facing Durham as it expands will be comparable to the facing of Clunish company. Now, the Clunish company is a proxy company. And with respect to the proxy company, what actually happens is that the equity beta of the proxy company is 1.57. Then what else is there? And the debt beta is assumed to be 0. Debt beta is assumed to be 0. So you have got equity beta of 1.57 and you have got debt beta of, what have you got? You have got the debt beta of 0. Got debt beta of 0. Now what next is there? The next situation is that it says the directors consider that facing systematic risk so and so so and so. It has 100 million shares in issue. Total equity shares is 100 million. Then what actually happens is that market value of each share is $2.4. It also has $75 million bonds in a statement of financial position. Bonds, $75 million. In its statement of financial position, which are trading at 106 per $100 nominal value. Market value of bond is 106. Assume that both Clonish and Drilling pays tax at an average of tax is 30%. And the risk-free rate of return is 3%. Market risk premium means RM minus RF is equivalent to 5%, right? RM minus RF is equivalent to 5%. Now, so this is something that we have got with respect to the cost of capital. And if you could see that one of the requirements that we have is that it talked about discuss how real options could be used alongside the net present value. That is one thing that we have to consider. The second thing that we have to consider is that we have to prepare a report for the board of directors. And in that report, we have to calculate suitable weighted average cost of capital that Durham company can use to discount the frontline project cash flows. Then the second requirement is that we have to estimate the present value, net present value in the dollars, ignoring the value of the follow-on project. So we're going to talk about that also. And then what you need to do is that you need to estimate the value of the follow-on project in dollars using the Black-Scholes option pricing model. Using the Black-Scholes option pricing model. And lastly, we have got discussing the assumptions of so and so, so and so, so and so. So this is what we have actually got. Now let's talk, let's discuss. So first of all, you need to calculate the weighted average cost of capital. I'm giving you 5 minutes. Give it a try. Then I'll start discussing. Give it a try. 5 minutes, and then I'll start discussing. The first thing that we need to consider is that we need to actually calculate the cost of capital. So for the cost of capital, we would be needing multiple things. We'd be needing the cost of equity, we'd be needing the cost of debt, we'd be needing all of these things. Now let's just try to understand this thing, that what exactly is this all about. So see, what happens is that you've got a proxy company. So proxy company data to be used, determine proxy asset beta. Asset beta is equivalent to equity beta multiplied by market value of equity divided by market value of equity plus market value of debt 1 minus T. So for the Clunish company, the market value of equity is gonna be what? The market value of equity is gonna be 1.5 100 million shares multiplied 2.4 million. The market value of debt is going to be Market value of debt is going to be 75 million bonds divided by 100 multiplied by 106. So 79.5 million. That's what the market value of debt is going to be. So what do you have? You have got 240 million. You have got 79.5 million. Now what next is there? So if I say D1 minus T, it is gonna be this multiplied by 1 minus 30% is 55.65. If I say E upon E plus D 1 minus T, so E divided by, sorry, it's E divided by E plus D 1 minus T. Now, so basically asset beta is equivalent to E divided by E plus D1 minus T. So asset beta is gonna be the equity beta multiplied by this. So 1.274480 is the asset beta. This is the business risk of Cloonish company. This is the business risk of Cloonish company. Now what next is there? Now, so for the equity beta, what do we need? We need the asset beta. Equity beta is equivalent to asset beta multiplied by E plus D 1 minus T divided by E. So what happens is that we need the E of need information of Durang. The E of Durang is gonna be what? E of Durang is gonna be what? It is actually gonna be this multiplied by this. This is E. Now D of Durang is gonna be 100 divided by 100 multiplied by 110. So you've got E, you've got D. Now what next is there? The next situation is E plus D 1 minus T. E plus bracket open D into bracket open 1 minus T, the tax rate. So this is what we have. So the equity beta is going to be equal to the asset beta multiplied by E plus D1 minus T divided by E. So 1.438 is what the acid beta is. So the cost of equity will be how much? KE is equivalent to risk-free rate of return plus equity beta multiplied by RM minus RF. So you have got 10.19%. How much have you got? You've got 10.19%. What have you got? You've got 10.19%. Okay, now 10.19% is the cost of equity. Now what we need is that we need the cost of debt. So how are we going to calculate the cost of debt in this scenario? Yeah, how exactly are we going to calculate the cost of debt in this scenario? Okay. See, yeah, any inputs? How can we calculate the cost of debt here? Yeah, any inputs? How can we calculate cost of debt? Okay, I give you 3 minutes, 4 minutes, you give it a try. Okay, yes, lovely Muhammad, lovely. So yes, this is how you are gonna calculate it. How? Very, very simple. It is actually gonna be like this. The cost of debt will be RF plus the credit spread. Plus the credit spread. So basically, what happens is that the cost of debt is gonna be risk-free rate of return plus 0.55%. So that actually gives you 3.55%. What does it give you? It gives you 3.55%. Now, what we are going to do now is that in order to calculate the weighted average cost of capital, we're going to say source of finance, the cost, sorry, the value, the cost in terms of percentage, the cost in terms of dollars. So the source of finance is going to be what? Yeah, you can do it. That's perfectly fine. Now see, source of finance is going to be equity. The source of finance is going to be debt. Now for the equity, we have a value which is 600. For the debt, we have a value which is 110. For the cost of equity, we have got 10.19. But for the cost of debt, it actually has to be this multiplied by 1 minus t. 1 minus t. So hence, resultingly, what happens is that resultingly, this is what it is gonna be. Resultingly, this is what it is gonna be. So you have the value, which is this 710, and you have a cost, which is this. Now, what actually happens now is that the weighted average cost of capital is going to be this divided by this, which is 8.99 or 9%. So are you all okay with this? Asset beta of the proxy company was used to calculate the equity beta, and that's how we calculated. Okay, lovely. Thanks, Mohammed, for the contribution. Now, the next requirement is basically this new investment project. And now what I want you people to do is that to calculate, what are you required to do? You're required to calculate the uh, net present value in terms of FF, in terms of FF. Now, can you just go through this, please? Can you just go through this, please? Can you give it a try? Yeah. So the requirement here is basically you have to estimate the net present value in dollars, ignoring the value of follow-on projects. Can you just go through it? Okay, now it says the finance director has prepared the following preliminary forecast for the new project in Frontline. All cash flows are forecast in nominal terms. Nominal terms means inflation adjusted. Year 1, 2, 3, and 4 units to be sold is this many millions. The revenue in FF millions is this. The relevant cost is this. Investment is this. Residual value is this. Tax allowable dividend is this. The exchange rate now, then the inflations of the multiple years is given. The only cash flow not included in the above analysis are as follows. Component cost. The new factory business unit in Frontline will need to purchase a component from Durong company to incorporate within the refrigerator manufacturing process. The new factory business unit in Frontline will need to purchase a component from Durong to incorporate with the refrigerator manufacturing process. Durong has agreed. Durong has agreed to fix the price of each component at $0.5 per unit produced and sold. Cost of this component should be treated as tax deductible expense in Frontline, and the contribution generated in Madonk, being 40% of the revenue earned, should be treated as taxable income. The extra tax due to in Madonk is going to be, it says the tax rate in Frontline is 10% compared to 30% in Madonk. Both countries' taxes are payable in the year that the tax liability arises, and any tax losses can be relieved in the next tax year. A bilateral tax treaty exists between the two companies. All net cash flows arising will be remitted back to the Durang. Now, see, what happens is that for the net present value calculations, what are the things that we need to consider? Let's just try to see what are the things that we need to consider for the net present value calculation. Now, first of all, you see this is basically the project 0, 1, 2, 3, 4. Okay. Time period 0, 1, 2, 3, and 4. Right? Then what actually happens is that the units are given, the revenue is given, relevant costs are given. Revenue. Okay. So you have got revenue like this 230, 250, 285. Okay. Let me just move it across. Here you go. No. Here you go. Okay. So you have got 230, 250, 285, 260. The relevant costs are gonna be 180, 199, 224, 202. The depreciation is 10, 10, 10, 70. Component cost is something that we would have to calculate. So first of all, the exchange rates. Time period 0, 1, 2, 3, 4. The exchange rate is 4.25 right now. And the exchange rate is quoted as FF2 FF2. So the inflation of FF is gonna be in numerator, and for the Madonk is gonna be in denominator. It's gonna be this multiplied by 1.05 divided by 1.06 equals to this multiplied by 1.04 divided by 1.06 equals to this multiplied by 1.03 divided by 1.04 equals to this multiplied by 1.02 divided by 1.04. So this is what we have, the exchange rates at different dates. Now the component cost is 0.5 per unit. Number of units, total component cost in terms of dollar. So the number of components is 10 million, 10 million, 11 million, 13 million, 12 million. Total component cost is going to be this multiply by now. Component cost in terms of FF is going to be this multiply by this, the exchange rate. So the profit before tax is going to be like this. Profit before tax is going to be like this. Tax expense at the rate of 10%. So tax losses can be relieved in the same year. So there's going to be tax benefit. Now the same depreciation that we deducted, we need to add it back. The investment is going to be of 200. The residual value is going to be of 100. So we've got the cash flows in terms of this FF. The exchange rate is going to be The cash flows in terms of dollars is gonna be this into this. Net present value, NPV function. In fact, we don't need to apply the NPV function right now. So this is the net present value. This is the cash flows in terms of dollars. Now, what do we need to do now is that we're gonna say cash flows in Modank, remittance from Frontland, time period 0, 1, 2, 3, 4. Extra tax at 20% on Frontland profits. So what is actually going to happen is that minus this into 20% divided by the exchange rate. Now, post-tax contribution from component sold. So your contribution in terms of dollars is this into 40% multiplied by 1 minus so the contribution, the revenue multiplied by 40% gives you contribution multiplied by 1 minus 0.3. Hence, resultingly, total cash flows in Modank is gonna be this. Cash flows in Modank is gonna be this. NPV at 9%. What was the rate? The rate was 9% for the WAC. Now the net present value at 9% is gonna be, I would suggest you to open the formula sheet, workspace help. So we've got the formula for the NPV is NPV, then rate, and then values equals to NPV, comma, sorry, the bracket open, the rate, comma, all the cash flows plus this cash flow. So 14.6 million is what the NPV is. 14.6 million is what the NPV is at 9%. 14.6 million is what the NPV is at 9%. Yes, it is in dollars, but we had to convert this into Frontland F. Yeah, is that okay now? Do you people understand this NPV calculation and workings and all that? Yeah, do you people understand these workings? Okay, lovely. And do you also understand the technique that I'm adapting to actually go about them? Now let's see. So follow on project is something that is there. Now, can you just go through this so that I could just help you understand further? Can you go through this? Okay, now let's see. It says the Durham company The Durham company directors have closely monitored the investment Cloonish company made in Frontland a few years ago and watched how the initial investment was supplemented by follow-on projects. They consider that if Durham company's initial investment project is successful, a further investment of $10 million in nominal value terms after 4 years could enable the company to generate the following post-tax free cash flows. This is in terms of dollar million. The volatility associated with these cash flows has been estimated at so and so, so and so, so and so. Now, there's one thing that I want you people to understand with respect to this. Let's try to see. So now what you need to do is that you need to actually, because um, for the part follow-on project, we would be needing few things. What are the few things that we would be needing? Let's just try to see. You need to have the present value of the cash flows expected. So that's going to be 5678. Obviously, you'd be standing at year 4. Cash flows are going to be 7953. 7953. Cash flows are going to be 7953. Um, the present value of cash flows is going to be like this. NPV bracket open. The discount rate, which is this, comma, all the values. 19.9847. Now, what do you need to do? You need to come on here and you need to apply the BSOP calculator. So for the BSOP calculator, what do you need? You need this. You need PA. PA is the present value of these cash flows. So 19.9847. 19.9847. PE is the exercise price, which is how much investment do you need to make. So it's like 10 million. R is the risk-free rate of return. Risk-free rate of return is 3%. 3%. Time period is basically how many years from now would this be exercised. So it is actually going to be 4 years from now. 4 years from now. Now, S is the standard deviation, which is the volatility. That's 20%. So you would actually get the value of the call option to be this. This is a piece of calculator that examiner has already given to you. So it get the value which is gonna be 11.16. Now, value of follow-on project is 11.16. 11.16. 11.16. Now you see what are we gonna do now? We're gonna say, okay, let's come on to the word processor. So basically, discuss how the real options theory can be used alongside net present value to help companies with their investment decisions. So what are you gonna do over here? You're gonna talk about that real life options exist. There could be option to expand, option to delay, which are actually call options. There could be an option to withdraw or the option to redeploy, which are actually put options. The existing projects are considered up to a certain period. However, if additional, the projects are considered up to a certain period. However, if additional benefits could be derived from those projects, then such benefits are to be considered. This would mean that in case if there is an option to delay, then such an option is to be considered. And the NPV assessment and the NPV assessment to be made. The weighted average cost of capital has been calculated in the attached spreadsheet. The net present value, it is turning out to be 9% approximately. R is the risk-free rate. The net present value of the project is estimated in the spreadsheet, and it is $14.62 million. The estimated value of the follow-on project will be $11.16 million. Now it says discuss the assumptions made in the above calculation and any further factors that would need to be considered before making a final decision on whether to go ahead with it. Now see, what happens is that when such a question comes in, so you have to write down all the assumptions that you have actually made while doing the calculation. Now what are the assumptions that you have made? So if I start off from here, the first thing is that the cost of capital, which is the risk that are faced by Cloonish company, are a close estimate of the risk that will be faced in the Plantland project. The cost of debt will remain unchanged even after undertaking the project. Duncan has sufficient cash flows to invest in the project. The cash flow estimates are reliable and estimated well. The cash flow estimates are reliable and estimated well. The tax rate is expected to be unchanged. The component contributions are expected to flow at the rate of 40%. The exchange rate is closely predicted using the using the purchasing power parity. Using the purchasing power parity theory. So you see, what have I done? I've actually incorporated all these things. So now what you could do is that you could just like take up all the cash flows, all the assumptions and just put it across. Then you have to mention the BSOP assumptions also. Then you have to actually mention about the working capital assumption also. So you see, this is how you actually answer a question. You get my point? This is how you actually answer a question. So when you come across a question and when you obviously you are not going to be writing the bullet pointers, you'd be writing you would actually be writing down the short paragraphs. But I'm just giving you a bit of an idea as to how things are going to be. I'm giving you a bit of an idea as to how things are actually going to be. You get my point? Yeah. Yeah, is that okay now? Now, just give me an input. How do you see the way that I've actually covered up this question? Yeah, please, need to hear an input from you. You could type out, you could actually, if you want, I could just allow you to unmute also. I think you can unmute also in case. I mean, I just want to hear a feedback from you. Yeah, thanks, Mohammed. Thank you. So you see, you understand how we actually handle a question. See, yeah, Bolu, if I would have been just going non-stop, then probably you would have not understood anything. So that's why I just took pauses in between, just to allow you people to actually absorb and think on your own as to what you should be doing and what you should not be doing. Okay, so I think that you people now get a bit of an idea, because you see, the biggest problem is usually question number one. How to handle question number one. That is usually the biggest problem for majority of the students. And now what you have done is you've actually got an idea that how you should be handling question number one. So if there is any question, do let me know, do ask. And the rest, I can see that Jeff Glazon and other few people are actually, if you've submitted many assignments and you've got feedbacks also. So that's really good to hear, good to see. Kudzi also, Moses Rajabo, you people have been doing wonderful. Shena, I think you did also submit the assignments, right? Okay, lovely. So thank you guys for being here. Thank you for your time. Thank you for being here. Hopefully you enjoyed the session, and hopefully you actually got an idea as to how things have to be done. Okay. Nick Daniel, are you struggling a lot with the interest rate risk? What exact area are you struggling? Okay, Zawadi, sorry. What area are you struggling in interest rate risk? Is it the whole, the interest rate future and everything, or is it like one specific area? Which option? Okay. Okay, so that means that you want me to do one question. Okay. I'm not doing it today. I would just schedule another session, probably on Monday or Tuesday, and I'll do it in that class for the specifically for the interest rate risk. Yeah, okay, Kuji will do it. Don't worry. So we'll do a dedicated risk management session, probably on Monday or Tuesday. That's what I'll be doing. So thank you guys. Thanks for your time. Thank you for being here. It was nice to have you all.